Welcome to Financial Planning Explained. I'm your host, Mike Menninger, certified financial planner, owner and founder of Menninger Associates Financial Planning. I'm pleased to have Nick DeVito, also a CFP and also a minority owner in the business. And thank you for joining me again today, Nick.
Thanks for having me.
So what we're going to talk about today is the various company stock plans. There's a small handful of stock plans. You've got restricted stock units, which are RSUs. The ESPP, which is the Employee Stock Purchase Program. You've got stock options, which are two different categories, non-qualified stock options, and incentive stock options. You've got ESOPs. You've got the 401k where you can buy company stock. And those are basically the 5 different ways that you can buy company stock through the company, more or less. So we'll start with the RSUs, the ESPPs, and stock options because they're after-tax money. The ESOP and the 401k are inside your 401k and usually are pre-tax. Fair enough?
Yeah, and what I would say is typically your RSUs, stock options, sometime the ESOP, they're generally reserved for a select group of individuals within the company. Typically, the higher you are in the rankings, that's when you may see those available to you. Typically, your rank and file aren't going to have RSUs or stock options, which you'll see the benefit, and we're going to cover it, that is likely going to be available to everyone in the company will be the ESPP, will be the company stock within the 401k.
And ESOPs, though. ESOPs are for you. And you were misspoke. You meant to say ESPP. I'm sorry, that the stock options and RSUs are usually granted for higher levels in the organization.
Sorry, that's correct.
Not the ESOP. ESOP's different. It's a different animal. So we'll start with RSUs. I mean, really, if you go back a ways, the most common probably 10 or 20 years ago were actually the incentive stock options. And then non-qualified stock options came into play. And more recently, there were tax law changes that no longer made it advantageous for a company from a tax perspective for the incentive stock options. Have you noticed that you don't see very many ISOs anymore?
Yeah, that is very true. You rarely come across those these days.
Yes, because the tax law changes made it so that it's not very the company doesn't get a tax deduction when they issue them. They only get the tax deduction when they're exercised. Well, a lot of times companies are doing some of these stock programs to get the tax deduction. Mm-hmm. So anyway, we'll come to stock options in a little bit. RSUs have become more popular ever since they took away the stock options. And they're a way of rewarding or awarding, I'm not sure what the right word is, people for, it's like a gift. It's a gift of stock. A lot of times, though, what you find with the programs that they provide is that there's a tendency for them to be golden handcuffs. And RSUs are one of them, where they give you the stock, but you have to wait a certain number of years before you can cash it in, which, that means no matter when you leave, you're leaving a bunch of RSUs on the table.
Yeah, what Mike's referring to there is a vesting schedule. So that period of time in which you still have to remain employed with the company to actually receive the benefit is that vesting schedule. And you'll see different types of vesting schedules out there. I would say the most traditional you'll see with the RSUs is a 3-year vesting schedule with 1/3 vesting each of the next 3 years. I have seen some where it's a 2 or 3 year cliff, meaning nothing vests until that year requirement is met, and then they all vest. And to Mike's point, they can be golden handcuffs. And a lot of times what they'll do is instead of you receiving a bonus, maybe you'll receive some bonus that's just regular W-2 income, and some of your bonus is going to be tied up in the RSUs, keeping you around theoretically for a little bit longer.
Right. And so, part of it is psychological, but it's proven to be so, is if you have a whole lot of stock or stock options or whatever in the company, the whole idea is it's golden handcuffs, meaning that if I have $100,000 worth of stock that's going to be due to me if I stick around, those are golden handcuffs. But what it also does is, forget the golden handcuffs for a moment. If you own the company stock, you're personally motivated for the company to do well. And that's what really they're trying to accomplish. Mm-hmm. You get everybody working for the company wants the company to perform well. That means people are going to perform better at their job. They're going to care more.
Yeah, I mean, let's take a look at an example. Let's say you're given 1,200 shares of your company stock as a part of your bonus, and it vests for 3 years once every year. That means each year, 400 shares come due. Obviously, to Mike's point, you want the share price of the company to be higher because that means you're receiving a bigger bonus when it comes vesting.
Correct.
And what will oftentimes happen with the RSUs is, let's say your 400 shares, it comes time to vest, they vest in December. Your 400 shares vests. What they will do oftentimes is they will sell some of the vested shares to withhold for taxes.
Right.
And you'll see that. And then the other, let's say 2/3 of your shares go into a separate account, 1/3 gets sold for federal tax withholding. So now you're left with 2/3 of those shares in an account that's set aside for you.
Yep. Sorry.
And one thing I'll caution on is, and we're going to talk a little bit more about this from a tax perspective, but sometimes you'll find that they do not withhold enough for taxes. For example, I was meeting with a client last week, actually. Her RSUs had vested. The max withholding for her RSUs is 22%. They're in the 35% tax bracket. So that means they're 13% shy on tax withholding for those particular RSUs because it's being stacked on top of all their other income.
Correct. And so to be clear, what Nick was pointing out is it's a gift of stock. And when the stock comes due, basically what happens is the day that the RSU vests, if you had those 400 shares and it was $30 a share, well, guess what? You just got $12,000.
Mm-hmm.
Beautiful. Well, understand that the tax treatment is ordinary wage income. Okay. As a result, it's going to show up on your pay stub. And so what you'll see on your pay stub is $12,000 of income, and they withhold all the income tax. Well, where did they get the money to withhold the income tax? They sell the stock. Okay. And because it's part of your wages, a lot of times it'll go through the payroll and they know, are you in a higher income tax bracket, a lower income tax bracket? But to your point, sometimes they don't, and they just withhold 22%. But they won't over withhold for Social Security tax. That's why I know it's integrated through payroll, because if it's in December and your RSUs come due and you're already above the wage base, they're not withholding the tax. So what they do to withhold tax is they very simply sell shares. So if I was given, 400 shares, what I have found is a common percentage is 40% of the shares. So if I have 400 shares, 40% of those shares is 160. They take and sell 160 shares, donate to all of the tax authorities, and I have an account that has 240 shares. Now, I tell this story a lot. I got an anecdote. It's kind of a cool one. So I went in to meet with a client who is a C-level individual. He's a director at his particular company. And I went in because he wanted me to check out his pension stuff. And the problem is that the pension stuff had to be on his computer because it was on the intranet at work. So I go into his office and we're tooling through and we're going through the different fidelity. And all of a sudden he goes through, it's like, wait, what's that? And I don't know. We look back and lo and behold, he had $130,000 worth of stock in his account. Okay.
That's a good day.
That was a good day. He had no idea he had it. Why? Because he was getting these RSUs. And because of the fact that it does not appear, other than if you're really looking at your pay stub, you'll see that there is extra pay in there, but your take-home pay did not change. It's whatever shares they sold were used to pay the taxes. Your take-home pay didn't change. You got no letter. You got no statement, nothing. Okay, it might appear on your brokerage account statement, but a lot of them are doing it online.
Yeah.
So here he accumulated stock from his RSUs over the span of like at least 5 or 6 years, because not only did he have like 136,000 in his company stock, but he also had $16,000 in dividends.
Yep.
Wasn't a bad.
He liked you that day.
He liked me that day. It's found money.
Yeah.
So stay tuned. We'll be back with you in just a few moments and we'll pick up where we left off.
Do you keep up regularly with your investments? Where exactly are your hard-earned dollars going? Are you financially prepared for an emergency?
I'm Mike Menninger, founder of Menninger Associates Financial Planning. We believe that education and knowledge are powerful, and we want our clients to understand why we are making the recommendations that we make. It's your money, and you deserve to know where it's going, because it's not how much you make, it's how much you keep. So call us today to discuss your financial concerns. Welcome back to Financial Planning Explained. We're going to pick up where we left off on talking about the stock options and the different types of stock plans that you can buy through your employer. So in summary, the way RSUs work is they give you the RSUs and they vest after a period of time. To Nick's point, the most common is a 3-year vesting date where every year after the first year, you get 1/3 of them vested. And you actually get cash in hand if you wanted to sell the stock or you have the ability to keep the stock. And the example we used, 400 shares, if they take 1/3 and sell them, then you got 267 shares that you can either sell right on the spot or you hold on to them. It's that simple.
Yeah, and to Mike's point, you have the option. I mean, the example you were talking about, they had all this company stock sitting in the account. You then have the option of, okay, do I want to keep the company stock or do I want to sell out of it? And the way I like to put it with all these stock programs, in particular RSUs, is if someone were to give you $10,000, would you buy your company stock? $10,000. Someone said, here's $10,000, invest it however you see fit. If you wouldn't buy your company stock, then I generally would say, okay, sell it and take the cash and then either use it for your cash flow needs, invest it elsewhere. And we'll talk a little bit about it later, but you don't want to be too invested or have too high of an allocation to your company stock. And that is one of the considerations as these programs are vesting for you.
Right. And so the other thing too is that if you were to sell it literally the day, and you could do that, you just say, I want the cash. There will be no capital gain for it because your cost basis is the actual value of the stock. So, I mean, you're already paying tax on it. So you're basically selling it at no gain or loss. Yeah. You're just taking the cash. Mm-hmm. The second thing we'll talk about is stock options. Just finding that RSUs are becoming more and more popular. Stock options are becoming less and less popular, but you do see them a lot. And basically what that does is, again, we talked about incentive stock options, which we'll talk about first and make it very quick, and then non-qualified stock options. Incentive stock options, what they'll do is they give you a stock with the strike price, which is always the value of the share on that day, okay? And let's say it's $20 a share. If the stock price is, say, $50 a share, I have the ability to go in there and buy that $20 a share, the stock at $20 a share. And if I hold it for 1 year, then that entire $30 becomes a long-term capital gain. So you have the ability to flip them immediately, and they're a short-term capital gain for that $30. But the other thing to point out is that $30 is also going to be considered alternative minimum tax, AMT. The good news is that AMT, with the 2018 tax law changes, really, they raised the limit to AMT to be so high, very few people hit it. So that'll be enough of the incentive stock options because, like I said, I don't remember the last time I saw them.
Yeah, it's been a while since I've come across them.
So they got basically shut down with the 2018 tax laws. And if no companies are doing it, the only people that you'd have are the people that were issued before 2018.
And what you'll find with the stock options as well is there's generally a vesting schedule for them as well. It's not often that you'll get the stock options and you can exercise them. I mean, to Mike's point, you're not going to want to do that because they're going to issue it at the strike price, which is going to be the stock price on that day. If you were to theoretically exercise it that day, there's no benefit to doing that. The other types of options out there are the non-qualified stock options. They behave in a similar manner from the sense of their stock options, there's an assigned strike price. The difference is the tax treatment. With a non-qualified stock option, let's say that we'll use the same example as before. Your strike price is $20. On the date of exercise, the share price is $50. So you have a $30 discount or a $30 gain that you're receiving. With the non-qualified stock options, that $30 difference there is going to be taxed as ordinary income
Correct.
too. So that's going to hit at the federal level. If you have a state tax, state income tax, you're paying it there. It gets hit with wage tax as well. So your Social Security and Medicare is going to be there, local taxes as well. So the non-qualified stock options are going to get hit by all taxation entities. And there is a level of strategy when you're exercising these options from a tax standpoint for multiple reasons. One, if you take a look at federal starting off, if you're in a very high income tax bracket this year and you know next year you might be lower and still have the stock options available to you, well, that could be a reason as to why you wait to next year to exercise. Because if you know you're paying tax on that difference in strike price and share price, well, then maybe wait until a year in which you're in a lower tax bracket. The flip side of that could also be true, particularly looking at the Social Security wage base. What I'll have some clients do is, let's say from a federal tax standpoint, they're going to be in the 24% tax bracket this year, and they'll be in the 24% tax bracket next year. But this year, they've already past their Social Security wage base. In 2025, once you make over $176,100, you no longer pay that 6.2% Social Security tax. Well, if they're already above that and we exercise the stock option, they're not having to pay that 6.2% tax on the difference between the strike and the share price. So there is strategy and a timing element to executing these stock options.
Absolutely. Because it's not how much you make, it's how much you keep. And if you can take 6.2% and prevent it from going to the government, great. And, again, you time it, you got to understand it, but at the same time, you got to be careful not to let the tax tail wag the dog, because we've actually seen it before where people's like, well, I'm going to wait. And by the time it gets to waiting, all of a sudden the stock value depreciated. So the other thing that happens is that I've seen people receive non-qualified stock options every year for a number of years. And, let's say, for instance, the stock price today is $60, but they were issued shares at $10. They were issued shares at 20, 30, 40, 50. And then it comes time to exercise the stock. They often ask, which ones should I exercise? Well, my thought process always has been this, is you exercise the ones that have the lowest strike price. And the reason why I say that is that, I'm going to be paying tax on, if it's $60 a share and I bought it or it was issued to me or granted to me at 10, I have a $50, gain. But I'm going to compare that $60, the $10 one to the $50 one. The $50 one, I only have a $10 gain. Well, why wouldn't I sell those? Because I only have a $10 gain, I pay less. Because if the stock price dropped $30, I only lose those 10. But if I have the ones from that I give them to me at $10 a share, I lose all 30. Mm-hmm. Okay, so it's a way of protecting yourself from having to lose more than you could lose. And if the stock price goes up $1, I actually make 10% on those other ones as opposed to, but that's not really the main reason why we do it. So the non-qualified stock options, I've even found, are becoming less and less popular because then companies just do RSUs. They seem to be the most prevalent ones that I've seen so far.
And one last thing on the non-qualified stock options, you're never going to want to exercise them if the strike price is above the current share price. There's no point. Why would you pay more for something that's worth less? Just putting that out there because I've had that question asked. Really, if the price is the same, there's no benefit. There's only ever a benefit because you're really only going after the discount of being able to buy it at a lower price. So if it's ever above if your strike price is higher than what the share price is worth, there is no point in exercising.
Right. So basically what's happening is I've even seen these things called SARs, stock appreciation rates. It's basically the same thing. I am getting whatever the stock appreciated, period. All right. Now let's talk about the ESPP. The ESP is the Employee Stock Purchase Program. The Employee Stock Purchase Program is where an employer gives you the ability to buy company stock, oftentimes at a discount. And I say oftentimes, usually at a discount. It is by rule capped at $25,000 a year. But some employers say, allow you to put up to 10% of your pay. It's after tax. So what happens here is, usually what happens, I say usually, is they have an offering period. Offering periods I find have been 1 year, 1 quarter, and twice a year. Twice a year is what I find to be the most prevalent. So that means on January 1st to June 30th, July 1st to December 31st, I have the ability to buy the shares. So what happens is they automatically deduct from my pay. If I said I'm taking 10% out of my pay and I'm making, $2,000 every 2 weeks, they're taking $200 out every 2 weeks and I'm buying the stock. Then on December 30th, they take the money that I put in. I said $200 every pay. That's going to be $2,600. Now I buy the stock. And usually they give you the ability to buy it at a discount. The most common that we see is they give you a 15% discount. So if the share price is $100 on June 30th, and I've been putting $200 every 2 weeks in, I'm buying $2,600 worth of stock at a 15% discount or $85. What I've also seen commonly is they give you the lower of the share price at the beginning or at the end. So let's say the stock started on January 1st at 80, oscillated and then finished at 100. I'm getting a 15% discount off of 80, which means I'm buying the stock at what? $68 a share and it's worth 100. Yeah. That is cool.
Yeah. What's important to note is whatever discount you receive, you're paying ordinary income tax on that. So
not immediately.
When you actually sell the share. So you're going to buy them. When you sell, you will pay ordinary income tax on the discount that you receive. So in the example you used, the 15% discount off of $100, you received a $15 discount. That's what you're going to pay taxes on when you when you sell the shares. You'll see, to Mike's point, the most common is 15%. Sometimes you'll see 10. Those are, I would say, the two most common. The max you'll ever see is going to be a 15% discount. You don't go above and beyond that. It's important to know, and this goes for all of the programs that we're talking about, you want to know exactly how these plans operate. And we talk about this often in our videos, but you want to look at the summary plan description for these plans. That'll tell you everything there is that you need to know. It'll tell you what the purchase period is. It'll tell you what for the ESPP. It'll tell you the purchase period, the purchase price, the discount, whether or not there's a holding period, which is very important to know. And we'll talk about the strategy behind that. But some plans, you'll have to hold your shares for a year. So you buy them at the end of that purchasing period. You have to hold it for a year before you can sell. Other plans, you can turn around and sell them right away. And there's strategy behind that in terms of, do you hold it? Do you not? And the trap I see some people fall into, particularly with the ESPPs, is it's great. You're getting a discount. But if the stock is losing value, your discount, and you hold on to the shares for a while. I had a client that I was working with a few months ago where she was putting money in all these years because she was getting a discount, but the share price was down 30% this year. All of the discount wiped away and all of the benefits she received wiped away because she was holding it as it was going down.
I've also had folks who weren't in the cash flow to be able to do it. And while I'm never a fan to borrow to invest, but one of the things that they were doing is they were basically, during each 6-month period, they were relying on their line of credit to help them get through the additional cost. But immediately upon the end of the 6 months, they sold the shares, paid off the line of credit, had some left over, right? The 15%, yeah. Especially if they're buying at a lower price at the beginning, they were able to sell all their shares, recoup that, and then they had money left over. Mm-hmm. And with that money left over, then they had that and they were using that to buy shares. They had to dip into their line of credit again a little bit. And at the end of the second 6-month period, they had enough shares to sell to pay off the line of credit and still have money left over to be buying shares from that point moving forward. They never fell behind. And what an opportunity for accumulation of wealth.
Well, if you think about it, if you're able to sell it right away and you're getting a 15% discount, you're locking in a 15% rate of return on your money before taxes. Sure, you're going to have to pay taxes on it, let's say it brings you down to after taxes, it's a 9% guaranteed rate of return. That's still really good.
I know, 9%.
There's not many investments out there that you can lock in a 9% rate of return on. And that's what I'll have people do. I have a number of clients that I'm working with that I have them. I said, look, max out your ESPP and sell it right away. If you have no holding period requirement, sell it right away. You're locking in that gain on your investment, and then you can do whatever you wish with that money. So
exactly. Thank you for joining us today. I hope you learned something about it. What we're going to do is we're going to pick up on the next episode, and we're going to talk about the other types of plans that you'll find are pre-tax. And there's some nuances. So those will be associated with an ESOP, which we're not going to get into that much. And then also your 401k, which opens the door for other opportunities. And then we're going to talk about the pitfalls of being in all these different plans, because a lot of people do. And all of a sudden they find themselves with pitfalls. So anyway, thank you very much. And if you have any questions whatsoever, please do not hesitate to reach out to us. You can reach out to us either by calling us at 610-422-3773, or you may go through our website, which is www.maaplanning.com. So thank you very much for joining us, and you have a wonderful day.